Thanks for viewing the introductory presentation for the all-stock growth at a reasonable price strategy. My name is Erica Jensen, and I'm the president of Respire Wealth Management in Houston, Texas. Clients have a lot of questions about this portfolio, and it starts with the most basic one: what is a stock? And that's a great question. We'll go over that, and then we'll move into a few other topics. People also become concerned about stocks, asking, is there a risk that I could lose everything I have invested? What's a dividend, and why is dividend growth important? What is a growth at a reasonable price strategy? And what is suitability, and is this suitable for me? Companies have a set amount of shares, and each share is owned by a shareholder. Some shareholders may have many shares of stock. Sometimes we hear stocks called equities because that's what they are. A shareholder owns part of the equity of a company. If you think about your house, the portion of it that you own, that's not the mortgage, is the equity you have in your home. The market value of a company changes every second as shares are traded on the open market. Stocks traded in the S&P 500 are mostly companies you know. If you don't have a lot of investing experience, there may be a couple of them on this list that you don't recognize, such as Berkshire Hathaway or Alphabet. Berkshire Hathaway is helmed by Warren Buffett and owns a broad range of companies, from jewelers to furniture and from chemical companies to underwear. A few household names you might recognize from the Berkshire portfolio are Acme Brick, Fruit of the Loom, Duracell Batteries, and Geico Insurance. Alphabet is the renaming of Google to represent that it's more than just a search engine. The company has many smaller subsidiary businesses in an array of tech areas that has expanded to phones, computers, medical technology, and more. But these are just the top 10 of the S&P 500. That means there are 490 more companies, and you consume the goods and services from many of them every day. So check your grocery bags, your toiletry shelf, who delivered your mail, where you purchased your fuel, or what company made the plastic that was molded into your kayak. If the stock market went to zero, all the goods and services we use and consume every day would no longer be accessible. The population is always growing, so there are always more people to consume goods and services. In fact, even though the S&P 500 is made up of American companies, many of those are global companies. So performance isn't even totally reliant on our economy at home. Over a third of the total market capitalization of the S&P 500 relies on international consumers in both developed and emerging markets. Looking at this 27-year history of the market, we can see that there was a fairly smooth bull market. That's one that's going mostly in an upward direction, followed by several peaks and declines. Now, the market's not only 27 years old. We're just focusing on this time period. We're going to discuss those peaks and declines. We're going to talk about why some of them didn't go as deep as others, and why some of them declined for years and took years to come back. We're going to start off with the East Asian financial crisis. We'll briefly look at the tech bubble. The tech bubble was amazing. During this time, they also called it the dot-com bubble or the dot-com bust. Companies were actually adding .com to their name to participate in the stock price frenzy that was pushing these prices up, 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 and up. This is the global financial crisis. During the recovery from that, we weren't sure what was going to happen. We were met just a year later by a Japanese tsunami and the economic issues in Europe surrounding Portugal, Italy, Greece, and Spain. Then in 2011, the U.S. credit rating was downgraded for the first time in history. In 2014, we saw rapid declines in oil prices affecting energy companies, which are major parts of the U.S. markets. And then in 2015, there was some deleveraging in China that affected the prices of our largest companies that have international exposure. Let's focus for a moment on the East Asian financial crisis and look at the 3-month peak at the very top before the decline. If you were just looking at this 3 months, it wouldn't look like any other 3 months in the market where we have normal corrections that occur all the time. The crisis actually began in 1997. Similarly to the credit crisis of 2008, there were rumors of problems for over a year leading up to the decline, but the market had mostly continued upward. The S&P 500 declined 17.9% following this before it rebounded on news of the IMF intervention and the affected countries. No one fully understood the depth of it or the connectedness that the U.S. actually did have. It had a huge impact on commodity prices and impacted countries far outside of East Asia, even in South America. Notice that the drop could have continued without intervention, but instead it went up for another few years. Now we'll discuss the global financial crisis in order to contrast the two. This is the 3 months of the peak in 2007, leading up to the big drop-off. Many scholars were already writing about a housing bubble, the potential for a mortgage crisis, but talking heads, analysts, CEOs, and others took to the TV screens to tell everyone that it was going to be okay. This 3-month period was the first tremor before the fallout. It doesn't look like much, and the index only lost about 7.7%. It even bounced back after the fact. And then it fell, over 56% from the top in 2007 to the bottom in 2009. The point that we just looked at, that peak, might have made it look to the average investor like it was just a normal correction or something temporary that could have happened in any year. Now imagine that you're sitting at the bottom in March of 2009, scratching your head and wondering what happened. Even in all of this doom and gloom, as we reached over 13% unemployment, there were still stocks that did okay. Have you ever heard of Church & Dwight? It declined a little over 0.5% from its high of $11.79 during the financial crisis. Yesterday, it was trading at $48.83. Do you know what Church & Dwight produces and sells that would prevent it from suffering a steep decline like the rest of the market? Cleaning supplies, like Arm & Hammer and OxyClean, Trojan condoms, first response pregnancy tests, vitamins, Nair, several different deodorant brands, lots of other things that I could name, but I'm not going to go into it. But many things that consumers buy even when they have less income, consumer staples. Walmart also did well. They actually gained about 9.5% during the crisis. That's because they're always loaded up with consumer staples, and when people are looking for alternatives to more costly goods, they tend to go to a discount retailer. It was $44.64 at the top of the index in 2007. Today it trades at $79.99. Now, with 13% unemployment, we've talked about people buying consumer staples, but did they want a $5 cup of coffee? Starbucks was already in decline before the index was, but measured from the top of the index at a price of $13.08, it lost about 68% to end up hovering around $4 per share before the index started to make a comeback. As of September 7th, the last time that I checked the price of Starbucks, it was trading at $53.50. So we'll say it's been trading around $50. Why would Starbucks suffer a greater loss than the index overall? Maybe people didn't want that $5 cup of coffee when the unemployment rate was so high. Here's that steep drop-off. And here's where you would have been in March of 2009. Look at that compared to today. This chart was pulled on September 6th to add to this presentation. So let's revisit Imaginary from the first slide where we discussed what a stock was. If Imaginary's current dividend yield is listed at 2% and paid quarterly, then we know based on their stock price of $25.32 that we could estimate a 12.66 cent per share dividend this quarter. Or if you have 100 shares, you know you could expect approximately $12.66. However, you wouldn't be able to divide the dividend yield by the share price to arrive at the actual dividend. The dividend yield percent is based on a more complicated calculation of a 12-month forward estimate based on additional data. In other words, you can do it the way I just did to arrive at the $12.66, but you wouldn't be able to do it in reverse order. Forward dividends can be estimated by looking at a company's cash flow, its revenue, profits, expenses, and losses. If a company is cash flow positive, it can choose to deploy that cash flow into research and development, expansion, acquisitions, or pass it along to investors. When it's passed along to investors, a dividend is initiated for the first time, or the existing dividend is increased. If you purchase imaginary PTC at $25.32 per share and it was paying a 2% dividend, over time the price goes up to $50.64 per share. That is not dividend growth. That is a capital gain. And it's important to note that your personal yield on imaginary is based on your initial cost basis or your initial investment price of $25.32. So what happens when a company raises its dividend? There's evidence that this is a very good thing. Standard & Poor's, who does a number of things besides issuing credit ratings, also manages many indices, that's plural for index, that are used as benchmarks in analysis. In 2014, they created a Dividend Aristocrats Index. These are companies from the S&P 500 that are known to have raised dividends each year for at least 25 years. Now, unfortunately, there's not a lot of history since it's a new index. We can't make up data to show you in the past. We can only show you indexes or indices that have existed. But I want you to point out or look at the red versus blue. I want you to see how those diverge. The red represents the Dividend Aristocrats and the blue represents the S&P 500 total return. You can see that those Dividend Aristocrats are performing better. In order to illustrate this further, I'm going to show you a chart from MSCI. That's another company that creates indices, and we're going to look at one of their indexes that doesn't include U.S. stocks, and we're going to look at its own dividend growth-centric version because it has a longer history. So this illustrates the same point. This is the MSCI EAFE, that stands for Europe, Asia, and the Far East. And we're going to look at their Dividend Masters Index, and we're going to look at this illustration of how dividend growth creates a divergence in performance. So you can see we've got more history to go off of here, going back to 2002. The blue-gray line at the top is the Dividend Masters, and the yellow one that's at the bottom with less return is the EAFE by itself. When evaluating the success of a strategy, one of the things we look at is the risk-reward trade-off. If we have two strategies with exactly the same reward, do we want the strategy to have a higher measured amount of risk or a lower measured amount of risk? We'd like our reward with less risk, please. This is a table showing us the value of an investment over time. It starts with $1,000 invested in each of 4 categories in 1979. You can see in the growth row that the category that performed the worst, sorry, my mistake, the category that performed the best was the category titled Growth or Initiation of Dividends. And that, as of the end of 2016, the investment that you made would be worth $128,670. You can see in the risk row that the category with the lowest risk, as measured by standard deviation, was also the category titled Growth or Initiation of Dividends. So take a moment to read the other categories and review their risk reward. Okay, this is exactly the same information as the last page, but I included it for people who do better with a graph or a visual presentation. So notice on the x-axis, that's the horizontal one, we have risk. As you move left, the risk is lower, and as you move right, the risk is higher. Now look at the y-axis, that's the vertical one. It shows growth. This represents the value of $1,000 invested in 1979 as it would look in an account at the end of 2016. This makes it pretty clear. Companies who initiated or grew their dividends during that time had better returns and for less risk. The purple dot is growth or initiation. It's higher on the chart and further to the left. Investors evaluate the fundamentals of companies and try to pinpoint stocks whose prices are expected to rise, even if they are already trading at a price that is considered to be higher than fair market value when they're looking for just a growth stock. And this is okay, except sometimes they're really just making an uneducated guess based on the fundamental data. It's better when a company can demonstrate that they're going to experience growth in their price. Metrics for earnings are typically good indicators of a company's stock price growth potential. When investors are looking for value, they evaluate the fundamentals of companies, and instead of pinpointing stocks for growth, they're trying to pinpoint stocks that are on sale. But buying something because it's cheaper than something else doesn't make it a value. This is a comparison of the stock price to quantifiable data about that company. You wouldn't compare two different companies. So you wouldn't say, well, this company's stock is $30 and this other company's stock is $2, so the $2 stock is a better value. Instead, what analysts are saying is, this company is currently trading at 30, but we believe based on earnings, assets, future sales potential, etc., that the company is actually worth $37 per share, so therefore it's a good value. But think about it like this. If you're a coupon clipper and you find a coupon for peanut butter, but your kid is allergic to peanut butter, you don't go buy the peanut butter just because you have the coupon. The efficient market hypothesis states that all publicly available data on present and future earnings of a company and potential outside influences are already taken into account in the stock price. Value investors don't think the data is already baked in. So the difference. Okay, GARP is a funny acronym. It's growth at a reasonable price. GARP methodologies pull the best from both worlds, identifying companies using quantifiable data that fall in the desired range of both value and growth. It really became super popular in the 1980s, hence the name, growth at a reasonable price. It's the sweet spot of overlap between the two. The Respire newsletter for the week of September 5th gave a Warren Buffett quote that explains the idea in simpler terms. In his 2008 shareholder letter, Mr. Buffett said, whether we're talking about stocks or stocks, I like buying quality merchandise when it's marked down. Note the word quality. If you aren't currently subscribing to the newsletter, email me or text me and I'll add you to the list. So when determining value, some investors look at price to earnings ratio, but looking only at that doesn't make sense. Think about Michael Phelps. He didn't win anything in the 2000 Summer Olympics, but they let him come back in 2004 because he qualified. And in 2004, he won 8 medals, 6 gold and 2 bronze. Would anyone at that point in time have said, he's peaked, can't do much more than that? So if you're using projected earnings to determine growth, on the other hand, sometimes those estimates severely miss the mark. Other times they're okay. When determining growth, some people consider an outcome that has some supporting data or some potential but is still an unknown. They're effectively gambling, but with better odds. The Respire methodology for both of these is very different. The next sentence may mean nothing to you, but that's okay. I'll follow it up with something simpler. To arrive at the value aspect of a potential holding, this multi-part calculation uses current return on equity, dividend yield, beta, and the current discount rate to calculate the value of a stock and compare it to the current price in order to determine if it is over or undervalued based on the present value of future dividends. The screen pulls stocks whose dividend yield is currently higher than the index average and is expected to increase or stay the same. The dividend discount model gives us value and dividend growth. That is, it's measuring present value of future payments. Do you remember having to calculate future and present value? To put this value evaluation into perspective, let's say you were purchasing a rental house. You found two houses in the same neighborhood in exactly the same condition. They were both about 1,600 square feet, and you knew that houses were renting in that area for $1.50 per square foot. So these houses would both rent for $2,500 a month. One house is selling for $180,000. The other is selling for $200,000. Which one would you buy? Obviously, the one for $180,000 because it's the better value. This part is easier. So remember, Respire's portfolio decisions are based on known quantifiable data. We talked about potential for future earnings as a method of selecting growth stocks. But what if that potential doesn't come to fruition? What if a company releases earnings reports that exceed expectations, though? That's a great thing, and that's known as an earnings surprise. So earnings surprise screens on their own are known to be effective methods for selecting growth stocks. By determining that a company has successfully achieved the first steps toward growth in share price, we're better off than if we were gambling on a maybe. So what does agnostic mean when selecting stocks? People always ask me this. It's not about religion. It's about not letting beliefs about a specific stock or sector or market environment cloud your judgment about investment selections. For example, retail. You might be reluctant to purchase a retailer due to grim news for that industry. I mean, Toys R Us just filed for bankruptcy this week, and we're hearing about a lot of other retailers closing stores. This method removes all speculations and beliefs about any particular segment of the market, and is based clearly and only on rules and quantifiable data. And here's what it does for us. Target, for example, was introduced to the screen on June 14th at $57.38 per share. As of September 14th, when it was removed, it was priced at $59.42. During the time it was held, it also paid a 62-cent per share dividend. This is growth of 3.56% in share price and a 1.08% dividend for a total return of 4.64% over a 3-month period. The total return of the S&P 500 was 3.19% for the same period. Not every stock selected experiences this level of return, but some stocks selected experience a higher rate of return. Target just serves as a great example because of the retail issue. Why speculative investment belief systems should not cloud judgment over a stock purchase. So it's affectionately called the beanstalk. And that's because the expectation is that this portfolio will achieve growth and pay dividends along the way. It's been given this nickname. Strict rules are used to make the determinations about the holdings each month. And so some clients ask, well, doesn't that result in a lot of transactions? The rules don't allow for control over the total number of transactions. So the number varies from month to month. July didn't have any transactions. August had 12. September had 8. It varies. Depending on the number of transactions in a given month, investors may realize short-term capital gains and losses in accounts. So it's important to consult a tax professional who might recommend limiting ownership of this investment model to a tax-deferred account such as an IRA. Any portfolio with 100% stocks is considered aggressive. So if you want to visit the website, you can click the Sign Up button to take the investor profile questionnaire. This may not be suitable for investors who have a short investment time horizon. If you're planning on taking the money for a pool in less than 2 years, I wouldn't recommend it. As we've seen, the market can take a while to come back from losses. It's also not a good portfolio for people seeking strong, steady income. The dividends are best left to reinvest. Also, performance reporting is provided quarterly or on demand by logging into the Respire client portal. Thank you so much for viewing the introductory presentation for the Beanstalk. If you have any questions, please call me at 915-0575 or email info@respirewealth.com. Go ahead and visit the site to check out your investor profile and investment model recommendation. Check on our other portfolios too. On the Insights page, you'll find some great facts, figures, and opinions. I also have a weekly newsletter that can be delivered to your inbox. Request it by emailing me. Thanks again, and have a good one.